is being
Good afternoon, everyone.
What is that? There, okay. And it's not. Thank you. I'm ready, right? So we can share now or?
Yeah, we'll give everyone a couple more
Yeah.
minutes and then we'll,
Not everybody is punctual.
yeah, very true.
Most people. but not
Punctual or early.
everyone.
Can they hear us now or they do? Okay. Okay.
They can see us and hear us.
The three, Angela, Elizabeth, and Carrie, and Robert, they're gonna ask the most questions tonight.
We won
They
that.
work for,
Oh, good. Awesome. Nice meeting you all.
Hi.
Hi, nice meeting you. I'm so honored to meet you, industry icon.
very nice to
Follow
meet
you.
you, very much so.
Yeah.
We're just gonna give everybody a couple minutes to get on. Hopefully not too long. We have 11 on before.
Do we see a count here or?
See 11 participants, 12.
Okay, why do you see that?
But. Hold on. See
Yep,
it?
right in the, yep, now
Bottom,
we're.
bottom left.
14, yeah, so far, okay, good. Okay, yeah, a few more minutes, it's still lunchtime, right, for some folks?
Yes. Yes, it is.
So our audience is, they represent various property owners, property managers, but they're BOMA
And
members,
assistant, yep.
We're BOMA members.
and they're young and they're comfortable.
They're
Mhm.
overwhelmingly, most of them are 35 and under.
Okay,
Handful older, maybe change of career, midlife career change.
okay,
And, less than 5 years in the business, overwhelmingly, many of them are assistant property managers or property coordinators.
Tenant
mostly
coordinator,
operations.
But mostly overwhelmingly operations. You might have a few folks here that work for vendors potentially. I don't know who actually signed up, but
Yeah, there's a couple.
that is mostly your audience.
Okay, good to know, good to know.
What we do with this group of folks is, webinars like today and lots of building tours. They go around to see various buildings, to see how buildings are operated
Mhm.
by, whether it's owner managers or third-party managers, and get to see lots of different iconic buildings.
As well.
All different types, old historical buildings, brand new product, and everything in between.
Good for them, yeah,
So,
good for them. The building systems may play a major role
oh, yeah.
in how a property is operated,
How it affects expenses. Yeah.
how finance.
And then if you wanted to share the screen, you can go ahead and share.
Go ahead, okay.
And then you can click on screen 1. Yep.
One here,
Well, I'm sorry, the one right below.
Yeah.
Yep, there you go. And then the blue share in the middle. Brilliant.
Okay. So our head count now at this point.
We are up to 19.
19. We'll just give it one more minute, folks, and then we'll get started, okay?
This definitely helps. Thank you.
Oh, you're welcome.
All right.
That's all the magic.
Yeah. I mostly Teams, that's why I'm not fluent. It's great.
Okay, we're at 21. Good, right?
That's pretty good, yeah.
Yeah.
All right, good afternoon, everybody. My name is Pat Dolan. I'm Chair of BOMA New York. And welcome today to part one of our financial webinar that has been developed for the Emerging Leaders Program. And today's topic will be expense escalation, okay? So I'm very, very happy to introduce to us our presenter today. His name is Syed Zaman. He works with JLL. He's the Tri-State Regional Financial Lead. So Syed is responsible for providing accounting support and guidance to multiple client accounts, including preparing, maintaining, analyzing, verifying, and reconciling complex financial transactions, maintaining the accuracy of the general ledgers and financial systems, ensuring proper revenue and expense recognition and construction projects, cost management of the construction projects, assisting in the preparation of periodic financial and operational reports, annual client budget and periodic forecast, annual audits, and year-end closing. So it is absolutely my pleasure to introduce today's speaker, Syed Zaman. Syed,
Good afternoon.
free to get started.
Good afternoon, everyone. And thank you, Pat, for that kind introduction.
Quite well.
I'm so pleased to meet everyone here. So I want to make this presentation as interactive as possible.
Yes.
I think through that, we're going to get more out of this presentation. Of course, we have an ambitious goal to cover CAM/expense escalation that includes tax, of course, real estate tax. We're going to talk a little bit about CPA escalation and other forms of methods of how to recover expenses for the property owner, of course, always being fair.
Right.
So with that, we're going to get through the slides. Again, I encourage you to ask questions by raising your hand or by logging questions to the chat.
Okay.
So expense escalations, of course, it is the general term. It involves CAM, taxes, all expenses pretty much that would qualify under a lease. There is the document we talk about. Under a lease, all expenses that can be shared between the property owner and the property's tenants, a subject property, of course. So we're going to go in this order. We're going to cover the material in this particular order. So what is escalation? We're going to discuss that, and you will find that I am repeating some of the terms that are critical, going to be critical when you discuss expense escalation. So bear with me, but I hope you're going to find value in those repetitions. So what is escalation to begin with? Again, we're going to go in this particular order today with some repetitions of key terms again. Now, what is an escalation? As you can see here, of course, we're going to share the deck later via email. So I would encourage you to revisit to get yourself more familiarized if you are not already are, which I presume that most of you are, given the industry that you work in and the kind of work you do, understanding your profile of the audience today. Now, so expense escalation is a key piece in property operation making sure your property is profitable for your owner and it is done in a fair and equitable way. So to begin with, whenever a new lease is signed or amendment is signed, there is base rent, there is additional rent. So the additional rent covers OpEx, real estate tax, and other expenses that are candidate for recovery by the landlord. Of course, lease guides that. As you are familiar with a commercial lease, an office commercial lease, I'm going to focus New York City. There is base rent that they come up with. They come up with a number which represents the market rent, right? Say you have a property, Class A property in Midtown Submarket Plaza, which is Grand Central area, north, few blocks, and say on the 20th floor, you have a tenant with 10,000 square feet coming in with $100 rent. Now, coming in at $100 rent, we all know that is base rent. We need to also know that $100 rent represent the expenses in it. So expenses could be a $20, say today they're coming in, a tenant coming in with $100 rent, base rent, and what are the components of base rent? I want you to know that. You probably know, but I'm going to illustrate that. What is it? $20 maybe OpEx, simplicity $15 tax, and the remaining that's $65 purely base rent. Now, as we all know that expenses grow. All expenses grow. Our household expenses grow. In the macroeconomic environment, microeconomic environment, expenses grow. So if the property owner doesn't bring in the growth in expense as revenue, they're losing money, right? And this is where the expense escalation comes in. The lease will provide for that, the methodology, why and how. Why is the science of it? How is the mechanics of its science? And art is understanding how you do it. The lease provides you guidance as to how it is done, but we do it in a consultative, in a collaborative way between the property owner, even the lease associates who signed the lease, if we need to interpret certain sections of the lease, and property's operations team, and maybe even tenants sometimes. Okay. Again, please ask questions so that, if anything left in a kind of confusion, I want to know, and I want to be able to clarify that to you. Now, in real world, in New York area, we mostly see base year leases, which is the one in the midsection. But there are also leases that are triple net and full service gross lease. Now, triple net, so you have a set rent, but the tenant pays for everything, all expenses. Sometimes tenant itself manages their expenses through a facilitator, what we call the facilities manager, right? Mm-hmm. And they pay for the expenses directly. Or the tenant have the property owner through his manager manage the building and pays for expenses based on his pro rata share. We're going to get to pro rata share concept later. And the next one is modified gross / base year lease. These are the predominant leases in New York City area, right? So we talked about a tenant coming in with a base year lease expense, say $15, $20 per square feet, $1 million, say overall simple number for that base year expense. And if expenses go over $1 million, based on a methodology stipulated in the lease, the tenant going to share any increase in the expense. The last one is full service gross. You never do CAM reconciliation. You never do tax reconciliation because the base rent reflects everything in it and it doesn't change. Some government tenants are set up that way, but most office leases in New York area that I know are set up as modified base year lease.
In my experience, I've only seen triple net or the modified base year. That's typically what I've seen in my career.
And that is the normal setup. So if you look at this, as a continuum, so triple net, you're gonna recover most expense, and in full gross, nothing, modified gross somewhere in between. Is somebody have a question there, or?
No, I don't know what that was. I don't see.
I think, yeah, no questions so far. Yep.
So now we get to little by little, we are now getting our feet wet. We're gonna talk about formation of expense management and how we go about, doing a CAM reconciliation, calculating expense recovery from our tenants. At the outset, you want to be familiarized yourself with this concept. Whenever you open this document, there is a content, right? Table of contents. It's going to take you to operating expense escalation sections, expense recovery section. But in the beginning, the lease will stipulate the key terms. For example, it's going to talk about the building's square footage. We are interested in rentable square feet as opposed to usable square feet. We'll get to that, why that is important. You're going to look at what is the space this tenant is renting, leasing. So tenants rentable square foot. And the next term, pro rata share. And there is nothing but a quotient of tenant square foot divided by building square foot. Now we're talking about rentable square foot as opposed to usable square foot. I will explain that later, and I would encourage question also if you have a question on that, why that is important. And then base year. The lease will tell you what is the base year. Typically, it is a calendar year. If your property is on a calendar year operation, then we'll talk about what calendar year, 2024, 25, and lease will give you the parameters of what those expenses are in that base year expense. And then key information in the lease document, similar to the top part of this presentation slide, is going to talk about definition of expenses. It's going to tell you also if expenses should be grossed up or not. Often they are. We'll talk about that in great detail. Actually, we're going to come back and forth to this concept and the methodology of gross up. Why we gross up and why we don't, and which expenses we gross up. And then this will tell you what expenses going to be excluded. And depending on the size and the savvy of the tenant, you're going to find that there is some differentiation as to which expenses are included, which expenses are not. We're going to get into detail of that. Property tax, in this part of the country, again, Northeast, property tax usually accounted for and recovery are calculated separately from CAM. Next page, this is again, get a chance, read up on it. I think it's important to understand this. So I want to say this here. Most leases in a particular geography, in a particular building are similar most of the time, with some variations, depending on the size and savvy of the tenant. A tenant will negotiate depending on how much rent space is leasing from the property owner, given the size of the building. And again, given the complexity and the savvy of the tenant, they will negotiate deeply on key terms. What expenses they want to see in their expense pool that property owner is allowed to escalate to them. And then what expenses are grossed up. As you can clearly see, he talks about what expenses are excluded. So depending on, say if you have 5 tenants in the building, you have a tenant A, a few expenses are excluded, tenant B, few expenses plus one more. You see what I'm getting at? You're talking about expense pool. Expense pool also can be some tenants having a 90% expense gross up versus some tenants are 95% expense gross up. Now, what is gross up? Gross up is you want to make the expense of a building as if the building is fully leased. Now, fully leased can be 90%, could be 95%. And again, that is a function of your lease document. It will be very clear. But in general, you're going to exclude landlord's expenses, direct costs that drive occupancy and profitability. Which are they? They are leasing costs, they are debt expenses, debt service expenses, advertising, tenant promotions, and again, other expenses related to profitability, and that drives occupancy. Any questions at this point?
I think I see two things in the chat.
Can we go to the chat, please?
So I can read it for you, or I can just go directly to the chat. Okay. So how are the owners handling the increase and the new tariffs being added? Would this somehow be built into an original lease, even though they were just enacted?
Good question. So whenever we do a CAM reconciliation, again, in the context of New York City, Northeast, we have a base year tenant, right? And we always say apples to apples comparison. If you have an expense in the base year, same expense, regardless of the size of the expense, you can include it in the comparison year, right? So say, hypothetically, you have a 2023 base year expense, pre-tariff, right? I think the question is about tariff. Come 2025, you are reconciling 2025 expense, whatever expenses you had in the base year expense, similar expenses in 2025 is going to be included in the expense pool, regardless of what drove the expenses higher. So it is tariff or a high inflation environment, whether it was
Labor costs.
Sure.
Utility costs.
Utility can be heavily impacted because of the tariff war that we are fighting or will be fighting. We don't know, very uncertain at this point with Canada, because a lot of our electric commodity comes from Toronto, Canada, to the upstate grid, electricity grid. So depends, right? But apples to apples comparison means if you have an expense in the base year, regardless of the increase in the comparison year, you ought to be able to pass it through tenant by, based on his pro rata share. Did I answer your question? Please let me know. Next question.
And feel free to come off of mute. If you have any questions, you can drop them in the chat or you can come off of mute.
Was that the only question we had so far?
Yes.
Okay, so next slide. And this is a lot here. So I would again highly recommend you take a moment to read this. This is the backbone of any OpEx CAM reconciliation, because we're going to get to a slide called groundwork. We're going to show how these key items, key factors that is included in your OpEx CAM true-up. But to quickly review the leases and set up the tenant schedule, tenant detail schedule, right? So again, like we talked about, tenancy square feet, building square feet, what is the pro rata share? Do we gross up any expense for this particular tenant? What is the tenancy period? Like when the lease started, when is it ending? For example, if you have a tenant whose lease started in 2025 and expired in 2024 in July, if your lease CAM schedule page doesn't have that, say, July 2024 expiration date, how do you know how many months of expense you're going to recover from this tenant? So that's why you want to include that lease start date and lease expiration date in that, CAM reconciliation summary page in the tenant details section. you're gonna review the tenant ledger, right? Sorry, general ledger, because general ledger is the Bible of what we do. As a property operations person, you review general ledger time to time to see if expenses was paid or accrued. Half of your building's expenses are driven by service contracts, whether it's elevator, your electric utility expense, cleaning, maintenance of various types. You want to make sure you have 12 monthly expenses accounted for, not more, not less. They could be actual payments, and if you're an accrual basis accounting, then if you haven't paid, then you have an accrual for it. Again, count 12 if these are service contracts. If these are non-reoccurring type, meaning other than service contracts, then make sure that expenses have been entered right to the right GL accounts and you've accounted for, and they're escalatable. Because you could have an expense that you book to a GL account, which cannot be actually included in the expense flow. So that's we're going to review that. We're going to get to that later. Now we talked about expense pools, right? That happens because you have some tenants on 90% gross up, 95% gross up. There are other issues too, and exclusions and inclusions of certain types that create expense pools. Determine tenant occupancy detail and the building occupancy detail. So these are two very critical factors, because building occupancy is going to drive the gross up of expense. For example, so there are two types of building occupancy. One is physical occupancy, be familiar with that, and one is economic occupancy or leased occupancy. We're going to get to that also. So the physical occupancy in and out of your tenants, lease expired, tenant vacated, the space remained vacant. So you want to have an average at year end to show that how much of the building was actually physically occupied from the January to December average basis, say 60%, right? And then if your lease tells you that those expenses should be grossed up to 90% or 95%, is very critical. The economic occupancy is how much of the building was occupied in terms of leased basis, not physical occupancy basis. And that is a factor, is important if you calculating management fee based on economic occupancy. Please do ask me if you have a question, I'll elaborate on that. And the remaining are like, you're going to create invoices and letters. Those are standard. You probably have a template. I've thrown in some examples of how they should look like. And then I really hit hard on reviewing your expenses by reviewing GL expense in detail. And please review those. You have a chance at year end to review your GL in detail so that you can do reclasses, book an accrual, book a manual adjustment if you need to, do the gross up as you're asked to. The other concept that you don't always consider, but one must be familiar with, is the concept of the landlord's ability to pass through capital expense. In general, usually you are not able to, as a landlord, pass through capital expense, but lease gives you a leeway meaning if those capital expenditures saved, is going to save the building energy, labor, meaning it will bring about savings, then lease will guide you as to how those capital expenses can be passed through via an amortization tool based on useful life or payback, period. Say you spend $100,000 in installing high efficiency light bulbs, the $100,000 is going to be recovered over 5 years based on a nice sort of guidance or your expert third-party analysis and engineer PE. then you can pass through those expenses over 5 years. Lease will tell you, you can add a finance fee to it or not. But I have thrown in example how you're going to go about calculating the amortization with or without a finance factor.
And I would just caution everybody too, as Syed had mentioned, not every lease is the same.
Yes,
So for medium to large size tenants, some of them are extremely savvy and negotiate excellent points. So it's always good to take a look at a lease about what you can expense and what you cannot.
thank you very much, Pat. Actually, I missed to highlight it. I have in my notes. You ought to read your lease
Absolutely.
because each lease is different. Thank you. It's a very critical point.
I'll provide an example. I managed a building where I had two very large tenants. And one lease allowed us to expense local law 11 work, right? And the other lease excluded it completely. So it was, a very interesting thing.
Amazing.
Yeah.
So if I can elaborate on that, when you talk about local law 11 or code-driven expense, lease usually make an exception for those, even though they can be capital in nature, high dollar value, ticket items. Lease allows you to pass them through. Most local law code-driven expenses are allowable expenses. You can pass them through. However, if this is a $5 million facade maintenance, right? Then you get into gray area. You want to get into advanced conversation with your property owner and your anchor tenant or sizable tenants, whether and how you're going to handle that based on the lease guidance. Very critical. I have seen a spectrum on that. Even a $5 million facade inspection expense, local law 11, passed through year one, $5 million one time. Some tenants not going to accept that.
Right.
You come to negotiation and you pass that through over 5 year, their 5-year cycle expense, right? So I've seen variations. Thank you very much. That's very good distinction, Pat. Appreciate it.
I have a question for you, or if Pat wants to answer. In the lease negotiations in the last, I don't know, 5 or so years, is it becoming like a pretty common topic to discuss local laws in the lease negotiations? Like, is that a hot topic recently?
I think it will obviously because of local law 97, I'm sure it's becoming more and more of a conversation. But I would have to say, Kyle, in most of the leases that I've seen over my, I'll go back to the last 10 to 15 years. Most of them have language similar to what Syed was just speaking about. So, I have not seen anything more recent that is making a change in that regard.
I concur. That's what I see in general, but there are always exceptions. So as Pat mentioned, and I really emphasize on that, each lease is different. Your anchor tenants, savvy tenants would negotiate these items in advance, and you're going to find that in your lease escalation clause. Very important point. And also in general, if I can, my thought on local law 11 and CapEx in general. In general, an expense, a capital expense, if it adds value to your property, it creates real estate value, and it is considered up, CapEx. So you are not allowed to pass it through. But again, lease has caveats, as we talked about. Local law 11 is one of them. For example, say you spend $5 million on FISP, local law 11, facade maintenance, $5 million. Some might say, oh my gosh, this definitely capital expenditures. Other tenants, they say no. Sorry, other clients say, property owners say, no, it is not. It didn't add value to my building. I was just complying to a code. I didn't rip off all brick layers in the building. I was doing pointing and repairing cracks. So
And a lot of people will view that as the landlord's responsibility to be in compliance.
there you go.
So
Yeah.
that's why I think, Kyle, like if you look at large block of tenants, large tenants in the last 5 years or so, the leases that we see coming out, they're going to new product. They're going to new product where they're not going to have to most likely deal with any kind of CapEx work for a very, very long time.
That's right. Yeah. That's true. So yes, again, lease is your guidance. I haven't read a recent lease that highlighted local law 11 or local law 97 issues, but typically the code-driven expenses are escalatable, whether it's your OpEx or CapEx, that depends on the lease guidance. One other thing, when you do these, any non-reoccurring items, large ticket items, you always want to keep it out of your base year expense. If you don't, you are undermining your recovery in the future years because your base is high. So be mindful of that, please.
So most of you will probably at some point in the future, if you haven't had it happen to you already, if you have large blocks of space that are going to become available that next year, when it comes budget time, you're going to see your organization really looking for you to be bare bones,
Yeah,
going in, preparing for base years. And they're really going to look for you to keep expenses very, very low for that base year when you bring those tenants in for the purposes of the ability to pass on the escalations
future,
in year one or year two rather, and on, knowing that these buildings are going to incur these expenses. So you'll be holding off potentially on some operating projects, OpEx projects, you know, keeping things tight. You might have already been in discussions like that, or you will certainly be in discussions like that at some point if you have a lot of leases rolling over and a lot of availability in your building.
yeah. Thank you for elaborating on that. And also a key point. So you're going to try to not undertake those non-reoccurring projects in that base year. But if you must, say a local law type project, then again, you're going to keep it out of your base year expense and you're going to escalate those to your existing tenants, but not that new tenant with that particular base year. How do I get to the next slide? Thank you.
You can press. Yep.
So this is just a general guidance for all of you. You're familiar with it, you know, how this, you know, the timing works. So most of us in our industry, we do budgets starting depending, except for a few owner. We usually do our budgets July, September, October timeline. So you estimate your expenses for next year. You do your CAM estimates, right? Starting January, you bill those estimates to your tenants. Come February through March, April, May, you go back and reconcile those. You know, next year you reconcile those expenses for prior year, like in the way we discussed in prior slides, and then you bill your tenants.
You guys might hear a term from time to time, true up.
Yeah,
Right, you're doing a true up at the end of the year.
Yeah.
To ensure that if expenses were, you know, not billed properly, you're passing on what the true expense.
That's right. Thank you.
Truing up.
And if you have an auditor and your tenants, your property owner puts you through an audit because it's a requirement, because of their reporting requirement, you wait until the audit is completed most of the time because you want to do the true up based on the audited numbers. But you should be ready for it because at year end, you're supposed to do a preliminary true up, at which point you're going to book an accrual based on the recoverable OpEx less what you budgeted. You might have billed them more than you're going to recover, so you're going to book an accrual for under. So this is the one I was talking about a few slides back, the groundwork. This is the summary page. Everything flows into this summary page from your service schedules or you do actual computation. I missed out, I apologize. What you want to show also in this page, in this summary page, the vacant spaces. And while you have the building square footage, this is scheduled to tie back to your RAND roll. When you do this, you want to have a RAND roll in front of you. So you want to have 100% of the building accounted for here. The next column, your tenants pro rata share. As we all know, pro rata share is tenants leased square footage, RSF, divided by building RSF. You want to be about 100% plus minus. By the way, buildings pro rata share can be more than 100% because of the loss factor. As you know, loss factor can move. It usually goes higher. depending on how many single tenant floors you have or multi-tenant floors you have, how much amenity space, how many elevator shafts, electrical closets you have. So loss factor determines what is the building's total RSF today versus few years ago. So that pro rata share can be more than 100%. So I want you to tie back these to 100% plus minus a couple percentage points. The start date and end date is very important. For example, if you're doing a 2024 reconciliation today, and you have a tenant whose lease expiring July 2024, you're going to calculate 7 months worth of expense recovery, not full 12 months. So this is very important detail. You want to have that here. Here you want to also show, are you grossing up any of the expenses, which you do in a different schedule? Are your expenses capped? Cumulative, non-cumulative? We're going to talk about that. I've sliced discussing that. And you have a reference point of base year expense. And what is that expense, base year expense? $1 million, $5 million, and that never changes once you establish unless there's a lease amendment. And what particular expense pool this tenant's expense belongs to, because you calculate your OpEx pool, various pools based on inclusions and exclusions. And now we move on to the detailed work, how we go about, truing up expenses. Any questions at this point? Because we're moving along. Okay,
We're good.
next page. So actual work. Looks like I've thrown in a trial balance, actually operating statement. And I'm only showing a partial snippet of it. So we are showing year-end total for that particular year. What we call prior year, say it is 2024, for example, make it 2024 prior year.
Can you see that slide, or is it just me? It could be just me.
No, it's me too. They can see it though. It's
They can
bigger.
see it?
Yeah, it's bigger for them.
Okay. So maybe they can see, I'm sorry, the fonts needed to be slightly bigger. So that you show the total expense there, for the year. And to the right, you start showing adjustments. If you need to reclass, we talked about reviewing your general ledger. If any of the expenses need to be reclassed from one GL to another, if you have any particular expense that is related to a tenant of yours, a particular tenant, you of course want to exclude that from the overall expense. Are you grossing up any of the expenses? We do that here. It's come from a service schedule that is tied to this page and things of that nature. And we get to the next page. We talked about gross up. So why is gross up important? Say 2020, you have a tenant came in when billing was 60% occupied. You had $1 million, just $1 million round for simplicity base operating expense, but billing was 60% occupied. Come 2024, that billing is 95% occupied. Now, for that particular tenant, if you did not gross up that 60% to say 90 or 95% as for the lease, you would have a very low base year expense, right? So come 2024, billing is 94%, 95% occupied. You have a huge increase in the overall expense, and you would be penalizing that tenant beyond any explainable, words that I have.
Right.
So the lease requires you, for that reason, for it to be fair and equitable, to gross up some expenses that are variable expenses, right? We're going to get to that. Look at the opposite of it. If a tenant came in when the billing was 95% occupied, say also in 2020, right? If you had $1 million expense, 2024 true up, the building is now occupied 60%. Just the opposite of what we discussed in the other scenario. If you did not gross up this 2024, you will be leaving a lot of money on the table, meaning the landlord would be hard financially. And that's why gross up is a fair way to address, movement in the occupancy in the building and how that affects your building's operating expense. Okay, what type of expenses we usually true up depends, right? Each building is different. Janitorial usually moves with physical occupancy. Some utilities, your supplies, cleaning supplies, other supplies. Management fees often is determined by occupancy, whether it's economic occupancy or physical occupancy of the building. So this is an example how you maintain a physical occupancy schedule in the building. Every month, you can update your schedule. So when come year end, you're gonna have a budgeted occupancy, right? Because otherwise you won't be able to estimate your budgeted OpEx recovery the right way. Come year end, you're gonna have true average occupancy. For example, this building was 69% occupied at year end, right? So now if this tells you you're gonna need to bring this expense up to 95%. Look at the multiplier, 1.37, which is 95 divided by 69.4. So the expenses, there are candidates, those are candidates for a gross up for occupancy adjustment is going to be vastly different for year end from your year end actual expense, which is in that column there to the left, right, middle. Now look, you have some expenses that are fixed regardless of your building's occupancy level, whether building is 80% occupied, 60% occupied, 90% occupied. Some expenses are fixed regardless of your occupancy. In this example, we are saying cleaning expenses are 12.5% fixed. In other words, if you had expenses of $33.6 thousand for 2024 in this example, you're gonna gross up 33.6 minus 12.5%, which is 4,300. I'm sorry, I'm saying, well,
42.
you're going to gross up, thank you, the 29.4 thousand by multiplying it by 1.37 multiplier, and then add it back to that fixed expense, you're going to get to the adjusted total of 44,441. You have most expenses, go back to fixed versus variable. Look at gas, water, and chilled water expense. Some buildings, these fixed percentages could be vastly different depending on the building systems, right, Pat?
Right.
If you want to add to that, but basically that's what it is. How the building is run, what kind of system is it? Where your chillers, how your chillers are set up, are they run on gas versus electric? That can depend what percentage of your building's electric, gas, water is fixed on.
Correct.
So you're going to true up the variable portion, or true up means gross up there, the variable portion of your expense. Any questions at this point? We are at 50-minute mark, so we're gonna pace through the balance. This is very critical, and this ties back to your physical occupancy schedule. I would highly encourage you to maintain a physical occupancy on a monthly basis. So come year end, there is no confusion about it, because if you have an anchor tenant in the building, sizable tenant, they're gonna look at your gross up, because the gross up is what drives your recoverable OpEx pool. That's very critical in your OpEx true exercise. I think we talked about capital expense and amortization. I'm not gonna.
We did.
Yeah, we did. I think in a few slides back in the beginning. I'm not gonna spend more time on it. And this is for your reference. And next page we show how we calculate. I actually put in the formulas there, and I offer my service to all of you. Reach out to me. I can provide you the Excel file how you're gonna calculate your annual amortization amount that you should be including in your OpEx expense pool on this particular project, should it be escalatable to your tenant. Now we're introducing expense cap, cum versus non-cum. So cumulative is saying if you have a 5% cumulative cap and say your expense increased only by 2% from base year, from last year, you have a 3% that you can utilize next year. For example, next year, your expense increased by 10%, but lease caps you to 5%, right? But you have a cumulative setup. In other words, you have a 3% cushion from last year. So you're going to be able to escalate 5% plus 3% that you did not utilize last year. You're going to recover 8% increase, even though you had 10% increase. In the same example, if you had a non-cum and you have 5% non-cum, you're going to be only increasing it by 5% next year because that is non-cumulative. But in the cum, you are increasing by 8% because you didn't utilize 3% of it last year. These are actual examples how you're going to go about calculating your expense cap, cum versus non-cum. I have only 5-7 minutes left.
You have that.
The next ones are demonstration of triple N. You throw in your trial balance or operating statement, line up all the expenses that are escalatable. You take a total, you take your tenant's pro rata share, and you calculate based on that and deduct any estimates you build throughout the year 2024, and you bill the tenant or give or issue a refund based on that recoverable less what you billed for 2024.
We don't like to be in the refund business.
That's right. That's why make a as good an estimate
That's right.
that you can. That's why your budget exercise is important, and you do a preliminary true up at year end before you do a final true up, so you can book any over under accrual, so your landlord's reporting reflects that true expense recovery income. So the modified gross is of course different because they have a base year. You compare to base year, look at the increase, right? And then you build the difference. Look at 75% there, meaning that tenant was there for 9 months of the year out of 12. 9 over 12, 75%. So you're going to do the calculation for 9 months out of 12 months. That's why the occupancy schedule for tenants is very important as well, as we talked about in that summary schedule. So now, how you invoice your tenant? Each property owner, each property has its own style and preference, but we never give our tenants to start out the entire operating statement. They don't need it. We should never give it more than we need to. We give them a statement based on expense categories, summary, subcategory level, like cleaning, repair, maintenance, utilities, security, landscaping, insurance, management fee, things like that. By the way, in this example, we threw in property expense, but property expense, tax expense, we usually calculate separately, right? And you to the right, this is the statement you send to tenant, and you attach a backup, which is to your left. You only provide a summary level OpEx in a statement for the year.
These terms may also, you might hear the term BOMA categories. Right? So
that's right.
People refer to these cleaning, R&M, security, and so on as BOMA categories.
Hey, thank you, Pat, for bringing that up. I would be remiss if I don't mention BOMA experience handbook. Is that what you call it?
Yeah.
Yes. Refer to that. There's a wealth of information knowledge in those BOMA handbooks regarding OpEx escalation came through. I threw in tax escalation for you. Please review. For me, even though we do the true up based on what is in my GL, in my trial balance operating statement. When it comes to tax escalation, I always get a copy of the actual tax bill. And because that's what tenant requires me to provide them on, I give them my tax escalation true up, right?
Mhm.
So I take the number from tax statement itself. I account for any credits in the statement, for example, ICIP, and I have the definition of what ICIP is. Please look it up. Some properties qualify for ICIP credit, and your tax statement reflects those ICIP credits. You're going to be following your tenants' lease tax escalation language to build them how you are required to. Remember the difference between fiscal year versus calendar year tax.
A good example of that is the city of New York, right? City of New York's fiscal year starts, I believe, in July.
July through June. Next year,
30th.
yeah.
So on the tax side, you'll see references to that, where in the rest of your operating expenses, you're most likely January, December.
Thank you. And of course, the tax year for New York is July. Tax year is the fiscal year, July this year to June next year. Very important. Your government tenants, be mindful, be aware, they want you to send money back if your tax expense for the current year lower than their base year. And there's an ICAP discussion there. ICAP relates to a particular building. A tenant does work to upgrade the space. They throw in TI dollars. The city gives them a credit. Usually it is a pass-through landlord statement. So there is no tax adjustment, expense adjustment for that line. So I threw in also CPI porter's wage. Porter's wage at this point becoming obsolete, but CPI is still relevant for some of the tenants, some of the buildings. If you have a city or a state governmental tenant, GSA. GSA is the #1 lessee tenant in the country. So they want CPI escalation, and this is how you do CPI escalation. You have a base year index, and you're going to go to the Department of Labor database, and you're going to take that particular CPI series or urban consumer, what have you, it will tell you, and then you're going to compare to the base year to current year. You look at the increase, and you're going to calculate the difference and build the difference.
I think we had a question in the chat.
Oh,
Please.
thank you, Kyle. He said that he had to run.
Okay.
Yeah.
Thank you, everybody.
Any questions?
Presentation.
Thanks, Kyle. All the best.
Thank you. Questions?
If a CAM expense is not used 1 year, the difference can be carried over to the next year and added to the new year? Question mark.
No, again, but your depends, right? Your lease is your guide on this. Usually you do a separate calculation, and this will tell you the timeline by when, 6 months or a year that you have to bill a prior year CAM expense. A year and a half is probably the range. But no, you cannot combine, or you cannot, accumulate a CAM expense. They have to be separate calculation because you have a base year expense. I hope I've answered.
That's why
your
it's so
question.
important to be familiar with the lease language. Really take a look through the clauses in the lease as it relates to operating expenses.
And again, you have my email address. Front of the presentation, do come back if you have any question.
Sorry.
The numbers are really different.
Brittany, you had a question, or your mic's open?
No, I didn't have a question. I just logged in. I apologize.
No
Okay.
problem. Thank you.
Okay,
I
Brittany.
don't have a question, guys. More of an favor or statement. Hold on 1 second. My phone is going off. I'll be right back.
Sure.
Hi, all. Just a quick question. If I wanted to find a little more information on these, would I be able to find it anywhere on the BOMA homepage, just like as resources to refer back to?
Well, this deck is going to be shared with all of you who signed up for this course, so you'll get to see these slides. And I think my suggestion is, compare some of the, information within this deck to maybe a lease in your building to kind of correlate the two. and you'll see lots of language within your lease that kind of speaks to this presentation.
Thank you, Pat. And I also want to add, yes, BOMA Experience Handbook, that is in particular relates to OpEx CAM true-up. Look that up. You'll be surprised how much information you have, reference you have there.
That is published by BOMA International. It's not necessarily published by BOMA New York.
Correct.
It is something, I believe it's called EER. That is published, that you can see stuff, on a national basis. You can see what operating expenses.
Got it. Thank you so much.
And we had a recording about this, question about the recording. So I'll be sharing it out after the session, and it's also going to be put on the BOMA website as a resource, so you can refer back to it.
Perfect. That was literally my comment, because unfortunately, I came in like 10 to 12 minutes late, and I feel like I completely skipped the first half, and where I sit at currently is chaotic. So it's really hard for me to dive deep into the presentation. So thank you so much for Tiara for clarifying that for me.
Absolutely.
And Margaret, if you have any questions, feel free to reach out to Tiara, and between Syed or myself, or someone here at BOMA, we can get an answer to you if there's something that you would need clarified.
Oh, perfect. I have a lot of questions actually. So this is great. Thank you so much.
Yeah, don't be shy. Do ask questions.
But I think big takeaway on this, guys, in my view, is, understanding the concept of base year and how and why we do escalations. And the big thing, folks that work with me at the Trade Center, we talk about this all the time. No lease is the same. A good portion of the lease form may be boilerplate in your organization, but some tenants are just, they had a better broker, they had a better attorney, they negotiated some key points. And those things could be different. So it really makes sense to become familiar with your leases.
Thank you so much. That makes a lot of sense, actually.
Okay.
Thank you, Pat. That's a great
Syed.
point.
Thank
That's
you.
a great point to add.
Thank you for bringing your years of expertise to our members. We appreciate it very much. I know this is a heady, subject, but it is something that you'll all be dealing with at points in your career. For those of you who may not be familiar with, say, for example, a general ledger, ask your manager if you could get a copy of the general ledger. If you were looking at the general ledger this time of year, if you looked in janitorial or security, you should be seeing at a minimum of 3 months expenses already posted, or potentially a 4th month. It just gives you a sense of how you're tracking expenses. For those of you, we talked about vacancy. If you're looking at a janitorial invoice, your cleaning company, QBS, ABM, whoever you're using, you might see if you have some large parts of the building that are empty, you might be seeing vacancy credits, right? You might be seeing vacancy credits on that because obviously you're not going to pay to clean space that's not occupied.
So you're going to gross up those expenses
Exactly.
if you have a
Exactly.
sizable vacancy. Again, lease by lease, yeah.
I think the key point for all of us to understand is the base year and then the escalations going forward, and the whole strategy. And every organization has a different mindset of how they're going to do that. But it's just a key concept of being a property manager. And it's just something that all of us should have a level of expertise in.
Yeah.
Most of you, and probably hardly any of you, will be sending these true ups to tenants, but it's good to understand the concept. If you have a large tenant comes in, has lots of questions, you'll be in a position to answer them, or you have the appropriate resources that you can direct them to. You just need to have good familiarity to a level of expertise when it comes to operating expenses, depending on your role.
And if I can add to that, actually, and never be shy to speak with your client or client's rep, your asset manager, because if you're not sure about a particular lease language, how an escalation setup should work, have those clarified very early on. Your property owner, you'll be surprised, or his or her rep, you're an asset manager, would be more than ready to help you in interpreting the lease language. Because if you're dealing with a savvy tenant, an anchor tenant with sizable presence in the building, then if you leave those questions unanswered, subject to interpretation, then you're going to find yourself in a hole. And I say this from experience with all humility. So keep an open mind, talk to your property owner, owner's agent, owner's rep, even sometimes your leasing agent, and through them, your legal rep, owner's legal rep, they can clarify certain things for you so that you're going to be always be ready on top.
So thank you for joining us. I think part two will be, right now it's slated for May 16th.
Yep.
And Tiara will be sending stuff out to you in due time. And that will be on, what's the topic on part two?
Reporting focused on variances.
So variances, things that you're all going to be doing in your lifetime. So good subject matter for you guys to get more knowledge on. So mark your calendar, that'll be on May 16th, most likely the same time.
That's right. I thought that was
Hope to have you all back.
Wednesday. Or was it? Maybe I got the date wrong.
All right, nice
Thank you,
meeting you all.
everyone.
Thank you, everybody.
Take care.
Thank you,
Thank
guys.
you.
Thank you.
Okay, well done.